Hi, it's Chrissy
And Marilyn with Fairway Independent Mortgage.
and we are here for Mortgage Monday. Today we're going to dive into debt to income ratios. So Meryl, what I hear a lot is my buyers are saying, I need to pay down some debts first. I need to pay off my debts and then I can buy a house. How true is that?
Well, it depends on how much you make and how much debt you have. Sometimes people do have too much debt and they need to be able to pay. They need to be able to pay those debts down in order to qualify for a mortgage.
Okay.
But then most people who buy a home do have other debts, student loans, car payments, credit cards, and they're able to buy a home despite those debts. You don't need to have everything paid off in order to buy a house.
Okay. So first, what is debt to income ratio? What does that mean?
Yeah, so I like to tell my borrowers that your credit score, it kind of determines if you can get a loan,
Okay.
right? I'm simplifying this, but and then your debt to income ratio determines how much of a loan you can qualify
Okay.
for. So your debt to income ratio looks at how much debt do you have compared to how much you make.
Okay.
And different loan programs have different limits as to how much your debt to income ratio can be.
Okay.
And it gets even more complicated in that there's a housing ratio, how much of your total income is allowed to be spent on housing, and then there's your total debt ratio, which is what people usually talk about when they talk about your total debt to income ratio. And on most loans, that's going to be in the range of 45 to 50% of your total gross monthly income. I say gross if you're a W-2 employee. If you're self-employed, it gets a lot more
Okay.
complicated than that. But if you're a W-2 employee, we get to look at your gross income,
Okay.
before taxes. And basically all of your debts, including your new proposed house payment, need to be below approximately 45%. Sometimes we can go 50, sometimes we can go 55, sometimes it has to be lower. There's some exceptions to every rule, but a general guideline rule of thumb is about 45 to 50%. So kind of make the numbers easy for a second. If your household income is $10,000 a month, then that means that we're looking for your total debts, including your new proposed house payment, to be below $4,500 a month. So let's say you have $2,000 a month in car payments and student loans and credit cards, then we'd be looking for your total house payment to be below $2,500 a month. Now, there's a lot of misconceptions about what the total house payment is going to be, because I think a lot of people get on Zillow or those websites where you see a mortgage calculator.
Yes.
And those mortgage calculators are usually calculated assuming that you're super A paper, meaning you're very well qualified. You're putting 20% down so you don't have mortgage insurance. And a lot of time they're not factoring in taxes, insurance, and HOA. And all of those items are included in your total debt to income ratio. So again, in that $10,000 and $4,500 a month example, you have $2,000 in other debts, $2,500 is allowed towards housing. Well, if the HOA is $100 a month, and then the taxes are $200 a month, and then the insurance is $75 a month. I mean, you get the idea.
Yeah.
All that stuff is going to count towards that $2,500 a month that you're allowed to have towards housing. So that's how a lender is going to be able to tell you, hey, this is how much of a payment you can qualify for. And most borrowers want to know, well, what purchase price can I qualify for? And most lenders will say, okay, well, you're good up to about $250,000 or $300,000 or $400,000, whatever your number is. But you've got to be careful with that, because let's say your lender told you $300,000 and you fall in love with this house in a super fancy HOA where the HOA is $300 a month. That might put your payment above what you're actually allowed to be at for your debt to income ratio. So make sure that you're kind of having that conversation, like in terms of the total payment. Usually when a lender tells you, okay, I think you're good up to about $300,000, they'll say, hey, I'm kind of factoring in, assuming that your HOA is going to be $70 a month, and then maybe your property tax is going to be $150 a month, and your insurance is probably going to be, $60 a month. So those are the estimates that I've put in when I told you $300,000. But if you end up finding a house that's got an HOA that's $150 a month, let me know, and I need to rerun these numbers and make sure you're okay on that purchase price.
Okay.
Does that all make sense? I know this might be a little
Yeah.
over analytical
Yeah.
for some people, and if it is, that's okay. We run this all for you. You don't need to calculate it, but I'm one of those, I like numbers, and I'm one of those people who really likes to kind of understand what to expect before I call somebody.
Yeah.
So I'm kind of trying to share a little bit about what all that stuff means. When you hear debt to income ratio, that's what we're talking
It
about.
really helps to break it down, because I think a lot of people don't know that the HOA is considered a debt.
Yeah, I mean, I guess it's not really a debt, but it is part of your housing payment. Oh, I'm sorry, I wasn't even planning on sharing this, but I just thought of another really important one that we see come up all the time, more and more frequently now, that is factored into the debt to income ratio: solar leases.
Okay.
You know, we're seeing a lot of homes with solar leases, and I know a lot of people don't love them. I think they're kind of cool. At the end of the day, you're kind of saving money. You know, maybe not be a lot, but when you know, let's take a house and say your average electric bill is $200 a month. Well, now you have a solar lease, and the solar lease payment's $170 a month, and you have no electric bill.
Yeah.
So it's almost like you're saving $30 a month, and in a way, it's kind of neat. They've got their pros and cons, and that's for everyone to decide. Now, when you buy a house without solar, we don't factor in the proposed, I mean, what the electric bill is going to be is not considered part of your debt to income ratio.
Yeah.
But if there's a solar lease, now it is. Now
Okay.
we've got to factor that solar payment into your debt to income ratio. So again, if you were qualified for $300,000 and you're buying a home right at $300,000, and oh, by the way, it also has a solar lease that's $150 a month.
Yeah.
That might not fit in your debt to income ratio. So make sure you're talking to your lender or me to say, hey, I found this house, I really like it. It's got the solar lease. Am I still going to qualify for it with that solar lease on there?
Yeah. Those are really good things to know because you think you're maxed out, and that's one of the things that people don't look at. I think, like the HOA is not listed at the very top of Zillow. It says like, hey, the HOA here.
You kind of got to dig for it.
You got to dig for it. You got to ask your agent for it, and then you got to get that number to your lender because he can build that whole puzzle piece of what that's going to look like under which program.
Yeah, exactly.
So, okay, so for people that are looking, like if they say, hey, I'm going to pay down all my debt so I can buy a house, what would you say to them?
I would say that you should probably talk to a lender first and find out if it's really necessary for you to pay down that debt. I mean, you know, everyone likes to pay down credit card debt because it's usually really high interest. But other debts that you have, like cars and student loans, are probably on a relatively low interest rate. And my personal opinion is, with how fast home values are rising right now, and with the fact that interest rates are really low, even compared to just a few months ago, interest rates are really, really great right now. It could cost you a lot more money by waiting to pay off those debts.
Okay.
You know, because let's just say that you've got these debts, this pile of debts, and it's going to take you 2 years to pay those off.
Yeah.
Well, let's just assume the market continues to do what it's doing. Well, the home that you wanted to buy just went up 13-14% in that year, and then let's just assume interest rates have gone up by 1%. Your monthly payment on that house just went up by $200 a month.
Yeah.
You know, I didn't bust out a mortgage calculator on that, but I'm just kind of sharing a scenario with you. So it could actually cost you a lot of money by waiting.
Okay, but is it going to cost them anything to talk to a lender?
Exactly. Yeah, it's completely free to talk to a lender and at least find out where you stand. You know, and again, you know, it's something we could share with you where we could say, okay, the good news is that, you know, right now your credit looks good and your debt to income ratio, yeah, we could qualify you for a house right now, but only $200,000 based on your other debts. But hey, pay those debts off, then we can bump you up to $300,000, and then you can decide whether that's something that you want to wait for or not.
Yeah, absolutely. And I think that's great advice to have a lender look at your situation first, see what kind of payment you can qualify for instead of going off and paying off, I'm going to pay off XYZ debt. I hear that a lot with, I forget the guy's name, but the guy with the program where we pay off all debts and have no debts.
Oh, Dave Ramsey.
Yes.
Yeah. No. Hey, no. I love the idea of paying off all debts. I think it's great for people to try to be debt free. My opinion is that it's not worth waiting to buy a house because of, you know, how cheap the money is to get and how quickly home values are rising. You know, I think you should buy a house, and you've got to pay to live somewhere anyway, right? So you're paying rent right now. Let's say you're paying $1,500 a month in rent. What if you could buy a house at $1,500 a month or $1,800 a month or whatever it is? You get the benefits of saving money on your taxes, being able to write some additional things. I'm not an accountant, talk to your accountant, but some tax savings, and you start building equity. You know, you're paying towards your own thing. You got it at a great interest rate. The rent prices are only going to rise more, so you got to pay to live somewhere anyway. If you can qualify now, I think you should buy now, even if that means you've got to buy something that's more conservative than your dream home, right? And then continue to pay off those other debts.
Yeah, absolutely, that makes sense. So talking to a professional, getting these things in order to buy a house, working a plan to get to that point, super helpful. So thank you so much, Merrill, for all that information. I see Anita said hi. Hi, Anita. And you can find Merrill on...
I will post the link to my mobile application
Okay.
website. If you want to go on there, or you can also just give me a call. I'll post my phone number in the comments as well.
That's awesome, and that app is really great because you don't actually have to talk to Meryl. Meryl's great. You
Yeah.
don't have to talk to me. You can plug
You
it all
don't have
in
to
there.
talk to me if you don't
and
want
get
to.
that info.
There's a really helpful mortgage calculator
Yeah.
on there. A few
Okay.
other tools as well. So.
Okay, perfect. And I'm Chrissy. You can find me on Facebook at littlehelperaz.com. Thank
All right.
you guys so
Thanks.
much for watching.